So now that we are familiar with the concept of different exchange rates that we have been talking about, we can use this to think about the question of which exchange rate regime to adopt, and use this as a background to think about some policy discussions about some financial crises as well as euro as a choice of currency. So we have got that many countries operate in the world under flexible exchange rates, right? So this would be situations where you have got the exchange rates are determined by market forces of supply and demand, with occasionally perhaps central banks intervening to actually step in and influence exchange rates if they think it needs influence, right? But typically they don't actually fix it by saying that this is going to be the exchange rate and we are going to stick to it. They allow it to be determined in the market. In contrast, you have got some countries which operate under fixed exchange rates. So this is a system where you've got two or more countries maintaining a constant exchange rate between their currencies, right? And you'll see that some countries sometimes go back and forth between these two different ways of operating of exchange rates. So one question to think about is what are the pros and cons of these different exchange rate regimes, right? So one can think of flexible exchange rates as the main problem being there is that the exchange rates might be fluctuating a lot if you just allow it to be determined by the market, right? And then it might be difficult to actually influence the exchange rate through monetary policy. So in that way, maybe fixed exchange rates are better, right? However, if you have fixed exchange rates and you allow perfect capital mobility, so you allow investors to domestic investors to purchase foreign assets and foreign investors to purchase domestic assets, then in that case, we'll see that that means that you are giving up actually two macroeconomic instruments that are there, right? So you are giving up control over the interest rate and the exchange rate, and that reduces the ability to respond to shocks, right? So yes, you end up actually controlling the exchange rate, but in return, you end up giving up control over these two macroeconomic factors, right? The other problem we'll see is that if you have got fixed exchange rates, there the anticipation of changes in the exchange rate potentially is going to actually lead to a mechanism which will often end up in financial crisis, right? So that is what we are going to focus on now to understand a bit better about how these sort of things work, because these have often been the source of financial crisis in different emerging economies in the past, right? Okay, so let's understand how exchange rate crisis can develop when you have got a fixed exchange rate. So imagine that you have a country operating under fixed exchange rate, right? And suppose that financial investors start thinking that there may be a devaluation around the corner. So what does devaluation mean? Devaluation means a decrease in the exchange rate, right? When you have got fixed exchange rate, right? So it's the analog of the depreciation term that we have been thinking, except for we use this term when we are talking about fixed exchange rate versus flexible exchange rates. Okay, so either the investors start thinking that there's going to be a devaluation, so which means a reduction in the value of the fixed exchange rate, or there's going to be a shift to a flexible exchange rate regime along with depreciation of the currency, right? Why might investors start thinking this is the case? So, for instance, it might be the case because they think that the domestic currency is currently overvalued. This can happen, for instance, in countries which have tied their nominal exchange rates to the currency of country with lower inflation. And if you have got higher inflation in the country along with the exchange rate being fixed, that would, as we have seen, lead to more and more appreciation of the real exchange rate, and that would lead to a worsening of trade conditions for this country, right? So if you remember, the real exchange rate was nominal exchange rate multiplied by the ratio of the price levels. So if you have fixed the nominal exchange rate and the price level in your country is moving faster than the price level of the foreign country to which you have fixed exchange rate, then that means your real exchange rate is going up. And that is basically means that your goods are now more expensive compared to the foreign goods. And so therefore less people would be interested in buying your goods, right? So that is probably not a sustainable thing. And in that case, investors might anticipate that there's going to be a reduction in the value of exchange rate coming up, right? So let's see what's the consequence of that. Remember that what we had discussed before is this interest parity condition, which says that the link between the nominal interest rate, the real interest, the nominal interest rate in the domestic country, the nominal interest rate in the foreign country, and the expected value of appreciation of the currency is given by this, right? Now, suppose that financial markets start believing that devaluation is coming, right? Then maintaining the exchange rate would require an increase in the domestic interest rate, right? Why is that the case? So let's imagine that initially the exchange rate is fixed at a particular level, E bar, and suppose that markets expected initially that the parity will be maintained over the period, right? So that they expected that the exchange rate next period is also going to be E bar. Then in that case, the interest rate just needs to be the same as the foreign interest rate. So you've got IT is equal to I star T. Now, suppose that participants start anticipating that a devaluation is around the corner, which means that there is a decrease in the exchange rate in the future, right? So with 75% chance, they believe that the exchange rate is going to remain at this same level as before. And with a 25% chance, they start believing that there's going to be a 20% devaluation. So then the expected change in the exchange rate is given by minus 5%. So this is 75% into 0 plus 20% into 25% into 20. So that's the 1/4 into minus 20%. So that's where you get this minus 5%. And in this case, if the central banks want to maintain the existing parity, what it must mean is that they need to now therefore have a value of IT, which is 5% more compared to the initial one that they had. Remember earlier they had IT is equal to the foreign interest rate. Now, if this is minus 5%, this term on the right-hand side, so if this is minus or minus 5%, so IT needs to be 5% higher, right? But this is something that we are talking about monthly interest rate, right? So that means that if we have the annual interest rate, that needs to be 60% higher. And of course, a 60% higher interest rate is going to, of course, be very bad for the economy, right? Okay, so if the financial markets believe that this is the condition, what are the possible choices that are available to the central bank? One is that they can try and convince the market that they actually have no interest of devaluing, right? And if this is persuasive enough, then we are back to this regime where the market participants expect that this is going to be the interest rate that's going, the exchange rate that's going to prevail in the future. The second option is that the central banks can increase the interest rate, okay, but by less than the amount that is determined by this condition. So they would increase it by not 5%, but maybe by a small amount of percentage, right? But this is likely to lead to large losses in the foreign currency reserves, because then they have to also intervene in order in the foreign exchange market, right? Otherwise, they'll be basically these other participants will be selling off the currency, and then the exchange rate would not be maintained, right? The other option is that they can actually set the interest rate as determined by the interest rate condition, but we have already talked about the fact that increasing the monthly interest rate by 5% in one go is a bad idea for the economy. Or the fourth option is that they can actually give in to what the market's expectation is and devalue the currency by the expected rate, and then that would actually lead to not changing the things, right? So the lesson that we get from here is that if there is an expectation that a devaluation may be coming, that can actually end up triggering an exchange rate crisis, right? So any of these outcomes are actually very complex for the economy. And this devaluation can occur even if the belief that, remember, the starting point of the story was the belief that financial market participants started thinking that there is a 25% chance that the currency will be devalued by 20%. But suppose that, this belief, there was no underlying economic reason to think this is the case. It's just that financial market participants suddenly started believing in this narrative that this is going to happen, right? So if there is a strong enough belief that this is going to happen, then even if the government initially had no plans to devalue, it might eventually end up being forced to devalue in order to prevent the interest rates going up or the foreign exchange reserves depleting, right? Okay, so this is the theory. Now let's see a practical case study, if you like, where all of these things played out. So this was the 1992 ERM crisis. So ERM stands for Exchange Rate Mechanism. And this was a financial crisis that occurred when the United Kingdom withdrew their currency from the European exchange rate mechanism, right? So what was the European exchange rate mechanism? So this was an exchange rate system which was established in 1979, where the idea was that within a set of particular countries, there's going to be a fixed exchange rate being maintained among these countries, right? So each member country who had joined this exchange rate mechanism had said that they are going to maintain an exchange rate of their currency with respect to the other currencies within a particular band. Okay. So UK joined this ERM in 1990 with a guarantee that they're going to follow economic policies which are consistent with preventing the exchange rate between the pound and other members of the ERM fluctuating by more than 6%, right? So this is the band part that they are saying that we are going to remain very close to the other exchange rate, right? Now, the problem was that UK had a economic condition which was actually different to the economic conditions of these other countries which were there. And most importantly, it had an economic condition which was different compared to Germany, which was one of the most important members of this Europe, right? So the UK had, for instance, much higher inflation, higher interest rate, and lower labor productivity compared to Germany. So let's see why this was a problem. So in the beginning of 1990s, the German central bank, they started actually maintaining a high interest rate in their economy in order to avoid problems related to inflation. Okay, so what had happened was that the two Germanys, West Germany and East Germany, had just reunited, and that was leading to an increase in output. And there was a fear that that would also lead to an increase in inflation. In order to prevent that, they started raising the interest rates. Right now, if you go by the interest parity condition, if you want to maintain the same exchange rate, let's say at this level E bar, if I star T is going up, this means that IT also needs to go up, right? So as a result of the German central bank increasing the interest rate, there was pressure on countries such as the UK, which to increase the interest rates accordingly to maintain their exchange rate parities. Now, the problem is that the financial markets started thinking that it would not be possible for UK to increase the interest rates by much, right? Because they already had higher interest rates. So an additional increase in interest rate was going to be further problematic for this economy of the country, right? So you had got currency traders, and a prominent example in that case was George Soros, who started building up financial positions that would become profitable if the British currency fell below the ERM band, right? So if the British currency devalued, right? So as a result of this belief, the currency traders started selling of pounds in large quantities on September 1992, right? So why was this the decision to make? Because they anticipated that the value of pound is going to fall, and hence they started selling of pounds, right? Now, in order to maintain the fixed exchange rate, so as to make sure that the value is not actually kind of like falling, the Bank of England had to accept any offers that they were getting of the selling of pounds by these currency traders, right? Now, in order to actually purchase pounds, you have to use foreign currencies, right? Uh, so the initial response was to say that, we are not going to devalue. That was, remember, response number one typically that have. But if that was not the case, then they started trying to purchase the pounds. But even that was not enough, right? So if we go back to the list of options that are available, so first this option was tried, that was not enough. Then the British central bank tried to kind of like raise the interest rate. So they raised the interest rate from 10% to 12% in order to make the pound more attractive. However, despite promising to increase the interest rate even more, the currency traders still kept on selling the pounds, right? And so at some point, the foreign reserves would kind of like go down much, and it was not worth trying to restore the pounds, right? And so the government ended up using the fourth option, which is to actually leave this exchange rate mechanism, right? And to actually devalue their currency, right? So make it more flexible and to actually lead to a depreciation. So it's estimated that as a result of this whole set of things that played out, George Soros actually ended up making more than $1 billion in profit by short selling sterling during this crisis, right? Because remember, short selling, you benefit if the asset that you are short selling actually falls in value. And that is exactly what happened in this situation, right? So we get that because of these different reasons, in general, flexible exchange rates are actually preferable, right? However, there are two important exceptions. So one would be a case when you have got that central bank cannot be trusted to follow a responsible monetary policy under flexible exchange rates. Then having a fixed exchange rate might be a way of committing to a certain path. So, for example, you would often hear this in the context of Latin American countries or countries which have high inflation, where they say that, by committing to follow a fixed exchange rate, they are actually tying up their hands in terms of monetary policy. And so, therefore, that would be a way of trying to bring inflation under control. And second reason where you might have fixed exchange rates being preferred is that when you have got a group of countries already tightly integrated, then a common currency may be the right solution, right? So if you think about it, if you have got countries basically which are operating under the fixed exchange regime, what we have seen before is that they are forced to have the same interest rate, right? Now, why is having the same interest rate a good idea, or when is having the same interest rate a good idea? If you have got basically the same type of macroeconomic problems and shocks that are happening to this country, then anyway they would have likely chosen similar policies, right? So then having the same interest rate is not really a policy constraint, and so forcing the countries to have the same monetary policy would not be a constraint, right? So, under what conditions would a set of countries might want to operate under fixed exchange rates or adopt a common currency? So, they need to satisfy one of the following conditions. Either they must be experiencing similar shocks, or if they experience different shocks, then the prices and wages must be such that they are flexible enough so that the adjustment happens by changes of prices and wages, right? So, for instance, if you have got two countries, one which is suffering, let's say, negative economic shock, then if wages fall enough in that country and prices fall enough, then you will have that acting as determinant to kind of like stop the reduction in economic activity, right? And they must also have high factor mobility in the sense that they would have like labor kind of like moving to regions which have high demand versus low demand, right? Now, if you think about it, one example where you have got this fixed exchange rate system is that the 50 states of the United States have agreed to have the same currency, which is the dollar, right? So they actually historically have satisfied these conditions for optimal currency area, right? In particular, they have had high factor mobility, and that would be a reason why this one of the three conditions was satisfied and then made sense to adopt a common currency. We can also think about in India, you have got these different states accepting the same currency, which is the rupee, right? And it might be worth thinking about, okay, which of these conditions are actually met by India in order to for them to think about having the same currency, right? So, what are the advantages of having a common currency? We have seen that there are disadvantages of having a common currency, right? You cannot have different monetary policy, for example, or different exchange rate policy. So, what are the advantages? Well, so one advantage of having a common currency is that for firms and consumers, it becomes more complicated if every time you are changing a state boundary, you have to use different currencies, right? And also, when prices are quoted in the same currency, it is often easier for buyers to actually compare prices and competition between producers to increase, right? Which also benefits consumers. So, because of these reasons, there are things to consider why to have a common currency, right? Now, an interesting development that has taken place in the last few decades is the emergence of euro as a currency, right? So, the number of European countries that use euro as currency is around 20, right? And this idea of euro is actually pretty new, right? So if you go back 40 years ago, there's different countries, Germany, France, all of them had different currencies, right? Germany had Deutschmark, France had franc, and so on, right? However, the idea originated around the 30th anniversary of the European Union that it might be a good idea to just have the same currency, right? In order to kind of like reap the benefits that we discussed here. And they discuss the transition in three stages. So in the first stage, you would have the abolition of capital controls between the countries constituting the ones who have decided to adopt euro as the currency. Then you are going to have to decide in the second stage about fixed parities between the different exchange rates of the different countries. And finally, in the third stage, you end up giving up all the different currencies and you just adopt a single currency, which is this euro, right? So this stage two was accompanied by a Maastricht Treaty, which also laid down conditions for joining the monetary union, right? So remember, you need to have similar economic conditions in order for it to make sense to be under the same conditions. And these were some of the things that were considered that you had low inflation, low budget deficit, low public debt, right? So these are basically fiscal and monetary policy conditions. And initially in 1998, you had 11 countries joining, but of course, not all European countries have euro as the currency. So major countries such as the United Kingdom, Denmark, and Sweden had stayed out, right? And the stage three, which was this adoption of a single currency, started in 1999. And instead of like different central banks of different countries, you had the European Central Bank, which became responsible for monetary policy for this area. And in 2002, you had the euro coins and banks were introduced, right? So, how strong is the economic argument for Europe as a common currency? Well, the benefits are similar for Europe as compared to the US, right? So you had this reduction in transaction costs and increasing competition. However, there is less agreement on whether Europe constitutes an optimal currency area, right? The reason is because none of the three conditions that we have discussed actually are true. You have got countries in Northern Europe and Southern Europe, which have very different type of shocks. Prices and wages in Europe are not really very flexible in the sense that they are often negotiated in advance and they are typically sluggish to move. And also, typically, there is less factor mobility within European countries, let's say, compared to US, because you have differences in culture, language, and so on, right? So as a result of that, it's a concern that these are not maybe necessarily the right set of conditions for this adoption of a single currency. And this eventually led to worries that, if there were some countries being hit by a particular negative shock, then they, because of them giving up this option of exchange rate policy and monetary policy to adjust to that shock, uh, then you might actually have a situation where these shocks would have long-lasting effects, right? So the European crisis, which happened in the late 2000s, was a situation when you had several countries in southern Europe facing shocks related to sustainability of the debt that the sovereign debt that the countries had taken. And there were worries that these countries would not be able to actually be able to repay back the debt. So that financial crisis actually showed that some of these worries were indeed justified, right? So when that financial crisis hit and the country's economic condition was bad, because the whole euro region was constrained to follow the same monetary policy, and the same exchange rate policy. So therefore, these countries which were hit by the financial shocks, where the other European countries such as Germany, France were not hit, right? But they were still forced to have the same policy. So then these countries could not use this exchange rate policy to actually get out of the crisis, right? So this was one situation where it showed what were the costs of using the same set of policies, right? Okay, so again, the reference for this part is the Macroeconomics by Olivier Blanchard, where you understand a bit more about different more case studies, as well as also a bit more discussion details on these choices between different exchange rate regimes and what have been the historical records. And also in other cases where having these exchange rates have worked out perhaps better for different countries.